the share of private credit borrowers that deferred at least some of their cash interest payments surged in the second quarter to the highest in almost 4 years, pointing to growing stress in the $1.7 trillion market, according to data from valuation firm Lincoln International. The percentage of debt investments with some sort of payment in kind increased to 11.4% in the quarter, according to Lincoln. That compares with 7.4% in the third quarter of 2021 when the firm began tracking the data. About half of that is considered bad PIK by Lincoln, which defines this as borrowers that started deferring interest payments during the life of the loan as opposed to when the debt was first put in place. The distinction is typically used to separate borrowers that use PIK and may be facing deteriorating performance from those that have always used the option. Overall, the data Lincoln disclosed in a new report on Tuesday paints the picture of a private credit market that's coming under pressure after years of breakneck growth. That's in part because private equity sponsors, which have relied heavily on private credit loans to finance buyouts in recent years, are also facing challenges. Whether due to a private equity fund's unavailability of capital or concern around investing further in troubled companies, quote, there have been some cracks starting to form in the relationships between private sponsors and direct lenders, end quote, Lincoln said in the report. Changes in average loan-to-value metrics, which measure the ratio of a company's indebtedness to the total value of its assets, are also suggesting pressure. LTVs for companies with bad PIK increased to 83% on average in the second quarter, compared to 45% at origination, according to the report, in what Lincoln called a, quote, clear sign of stress, end quote. The firm's official default rate for private credit rose to 3.4% in the second quarter from 2.9% in the prior period. However, the firm said the statistic may be, quote, disguised by significant amendment activity, end quote, as lenders can tweak credit agreements to prevent defaults from materializing. Lincoln's shadow default rate for the market, which is calculated by looking at bad PIK investments as a proportion of total investments, stood at 6% in the second quarter, compared to 2% back in 2021.